One of the most common and dangerous pitfalls of stock picking is confirmation bias. Confirmation bias is the tendency to seek out and prefer information that supports our pre-existing beliefs, and to ignore or reject information that contradicts them. Confirmation bias can lead us to make poor investment decisions based on incomplete or inaccurate information, and to miss out on opportunities that challenge our assumptions. How can we identify our own biases and avoid confirmation bias when researching stocks? Here are some tips. Recognize your biases and assumptions. Know what you believe and why you believe it. Be aware of your personal preferences, values, emotions, and experiences that may influence your judgment. For example, if you are a fan of a certain brand or product, you may be biased toward its stock performance. Examine the data carefully. Ask yourself, is the evidence robust? Is it from a credible and reliable source? Does it cover all aspects of the company or industry? Does it account for potential risks and uncertainties? Does it show both strengths and weaknesses? Don't rely on headlines, opinions, or anecdotes. Look for facts, figures, and analysis. Beware of the common statistical mistakes. Don't confuse correlation with causation. Don't overgeneralize from small samples or outliers. Don't ignore the margin of error or confidence intervals. Don't cherry-pick data that suits your narrative. Don't fall for survivorship bias or hindsight bias. See how a different perspective might change how you interpret the data. Seek out alternative viewpoints, opinions, or evidence that may challenge or contradict your views. Compare and contrast their arguments, methods, and findings with your own. Try to understand their logic and reasoning. Be open-minded and willing to change your mind if the evidence warrants it. Accept the possibility of uncertainty. Don't be overconfident or arrogant about your predictions or conclusions. Don't assume that you know everything or that you have all the answers. Acknowledge the limitations of your knowledge and the complexity of the market. Be humble and curious. By following these tips, you can reduce the impact of confirmation bias on your stock picking process. You can make more informed and objective decisions based on a comprehensive and balanced analysis of the available information. You can also improve your critical thinking and learning skills, which will help you become a better investor in the long run. One of the most important skills for an investor is to be able to evaluate the performance and potential of different stocks. There are many factors that can affect the value of a stock, such as the company's financials, leadership, competition, industry trends, and market conditions. However, not all factors are equally important or relevant for every stock. Therefore, it is essential to use objective criteria and data to analyze stocks and compare them with each other. Objective criteria and data are based on facts and evidence, rather than opinions or emotions. They can help investors avoid bias and prejudice when making investment decisions. Bias and prejudice can lead to irrational behavior, such as buying overvalued stocks or selling undervalued stocks based on hype, fear, or personal preferences. Objective criteria and data can also help investors identify opportunities and risks that may not be obvious from a superficial glance at a stock. There are many sources of objective criteria and data that investors can use to evaluate stocks, such as financial statements, analyst reports, industry reports, news articles, and online tools. However, not all sources are equally reliable or accurate. Investors should always verify the credibility and timeliness of the information they use, and cross-check it with other sources if possible. Some of the most commonly used objective criteria and data to evaluate stocks are price to earnings, PE, ratio. This ratio measures how much investors are willing to pay for each dollar of earnings that a company generates. It is calculated by dividing the current stock price by the earnings per share, EPS, of the company. A high P/E ratio may indicate that a stock is overvalued or that investors expect high future growth. A low P/E ratio may indicate that a stock is undervalued or that investors expect low future growth. However, the P/E ratio should be compared with the industry average and the historical range of the company to get a better sense of its relative value. Price to book (PB) ratio. This ratio measures how much investors are willing to pay for each dollar of assets that a company owns. It is calculated by dividing the current stock price by the book value per share, BDPS, of the company. The book value is the net worth of the company's assets minus its liabilities. A low PB ratio may indicate that a stock is undervalued or that the company has strong assets. A high PB ratio may indicate that a stock is overvalued or that the company has weak assets. However, the PB ratio should be adjusted for intangible assets such as goodwill and patents, which may not be reflected in the book value. Price to earnings growth (PG) ratio. This ratio measures how much investors are willing to pay for each unit of earnings growth that a company achieves. It is calculated by dividing the P/E ratio by the annual EPS growth rate of the company. A low PG ratio may indicate that a stock is undervalued or that the company has high growth potential. A high PG ratio may indicate that a stock is overvalued or that the company has low growth potential. However, the PG ratio should be used with caution, as it depends on the accuracy of the EPS growth projections. Dividend yield. This ratio measures how much income a company pays to its shareholders in relation to its stock price. It is calculated by dividing the annual dividend per share (DPS) by the current stock price. A high dividend yield may indicate that a stock is undervalued or that the company has stable cash flows and profits. A low dividend yield may indicate that a stock is overvalued or that the company reinvests its earnings for growth. However, the dividend yield should be compared with the payout ratio, which measures how much of the earnings a company distributes as dividends. These are some examples of objective criteria and data that investors can use to evaluate stocks, but they are not exhaustive or definitive. Investors should always consider their own goals, risk tolerance, time horizon, and personal preferences when choosing stocks to invest in. They should also monitor their stocks regularly and adjust their portfolio accordingly if there are any changes in the market or in the company's performance. In this section, we will talk about how to diversify your portfolio and balance risk and reward based on your goals and preferences. Diversification is the practice of spreading your investments around so that your exposure to any one type of asset is limited. This can help reduce the volatility of your portfolio over time and protect you from losing too much money if some of your investments underperform. To build a diversified portfolio, you need to consider three factors: your risk tolerance, your time horizon, and your investing goals. Your risk tolerance is how much risk you are willing to take with your money. Some investors are more conservative and prefer safer investments that offer lower returns but less chance of loss. Others are more aggressive and seek higher returns but accept more volatility and potential loss. Your time horizon is how long you plan to keep your money invested. Generally, the longer your time horizon, the more risk you can afford to take, since you have more time to recover from market fluctuations. Your investing goals are what you want to achieve with your money, such as saving for retirement, buying a house, or funding a college education. Based on these factors, you can allocate your portfolio among different asset classes, such as stocks, bonds, cash, and alternative investments. Stocks represent the most aggressive portion of your portfolio and provide the opportunity for higher growth over the long term. However, they also carry the most volatility and risk of loss in the short term. Bonds are generally less volatile than stocks and provide regular income and stability. However, they also offer lower returns over the long term and are sensitive to changes in interest rates. Cash and cash equivalents, such as money market funds and short-term CDs, are the safest and most liquid investments, but they also provide the lowest returns and may not keep up with inflation. Alternative investments, such as commodities, real estate, or cryptocurrencies, can add diversification and enhance returns, but they also come with higher risks and costs. There is no one-size-fits-all formula for how to diversify your portfolio among these asset classes. It depends on your personal situation and preferences. However, a common rule of thumb is to subtract your age from 100 and use that number as the percentage of stocks in your portfolio. For example, if you are 40 years old, you could have 60% of your portfolio in stocks and 40% in bonds and cash. This is a simple way to adjust your portfolio as you get older and become more conservative. Another way to diversify your portfolio is to invest in different types of stocks and bonds within each asset class. For example, you can invest in large cap, mid cap, small cap, value, growth, domestic, international, emerging market, sector specific, or dividend paying stocks. Similarly, you can invest in government, corporate, municipal, high yield, international, or inflation protected bonds. By investing in different types of stocks and bonds, you can reduce your exposure to company-specific or market-specific risks and take advantage of different opportunities. One of the easiest ways to diversify your portfolio across different asset classes and types of securities is to use mutual funds or exchange-traded funds, ETFs. These are pooled investments that hold hundreds or thousands of individual stocks or bonds or other assets. By investing in a single fund or a combination of funds, you can gain instant access to a diversified portfolio that matches your risk-reward profile. Diversifying your portfolio is not a one-time event. You need to monitor and rebalance your portfolio periodically to make sure it stays aligned with your goals and preferences. Rebalancing means adjusting the weights of each asset class or security in your portfolio to bring them back to their original or desired levels. For example, if stocks perform well and bonds perform poorly over a period of time, your portfolio may become more stock-heavy than you intended. To rebalance it, you would need to sell some stocks and buy some bonds or vice versa. Rebalancing helps you maintain your desired level of risk and reward in your portfolio. It also forces you to buy low and sell high, which is the essence of successful investing. You can rebalance your portfolio manually by reviewing it at regular intervals, such as quarterly or annually, or automatically by using a robo-advisor service that does it for you based on algorithms. To summarize this section, diversifying your portfolio means owning a mix of investments within and across asset classes that match your risk tolerance, time horizon, and investing goals. Diversification can help you limit losses and guard against risk by reducing the volatility of your portfolio over time. You can diversify your portfolio by allocating it among different asset classes, such as stocks, bonds, cash, and alternatives, investing in different types of securities within each asset class, such as large cap versus small cap stocks or government versus corporate bonds, using mutual funds or ETFs that offer instant diversification at low cost, such as index funds or target date funds, and rebalancing your portfolio periodically to keep it aligned with your desired risk-reward profile.